Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is led by ICICI Prudential Asset Management Company Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Versha Jain from Outlook Money. Welcome to another episode in our podcast series where we simplify the complexities of finance to help you enhance your financial acumen and work towards financial well-being. Brought to you in association with ICICI Prudential Asset Management Company Limited. In today's episode, we will discuss quality ETFs or exchange traded funds. The latest report by the Association of Mutual Funds of India, or say AMFI, for January 2025 shows around a 3.7% decline in net inflow in open ended equity schemes. But at the same time, a marginal growth of 0.50% in the net asset under management compared to last year, December. While the market has been reeling downward for the previous few days, what could be the right time and strategy to invest in equity funds? When we talk about a strategy, the quality factor is associated with providing stability to the portfolio and especially when the market is falling. Our topic of discussion today is around the quality ETFs. Do they invest only in secure large caps? The risks involved, because however stable in the end, the investment is in equities and much more. To shed light on this, we are joined by Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC. Let's unravel the quality for a careful and successful investment. Welcome, Mr. Haria, to this episode.
Thank you, Varsha. Always a pleasure. Thank you.
As quality is defined as a factor in investing, for the benefit of our listener, could you please explain this factor and how it is measured and how does it apply to ETFs?
Sure. So, as our listeners have had a lot of discussions on the multiple factor based ETFs, they would recall that the factors can be price factors, which is essentially based on the stock prices like momentum, volatility, or they can be factors which are based on fundamentals, which is essentially valuations, quality, etc. Today's topic of discussion is based on the fundamental factor of quality, which essentially is defined generally as the ability of the stocks to generate returns, which is essentially their return on equity is one parameter. At the same time, keep the debt levels low, which is debt to equity is another parameter. And third is how stable are their profits, or the variability in profits should be less so that the business quality is good. So essentially, quality as a factor is defined generally by taking into account those stocks which have low debt to equity levels, which means the risk of bankruptcy comes down significantly. They have a high return on equity, which means that the ability of the business to generate profits for every amount of rupee that has been put in the business is significantly high. And at the same time, they are able to basically have steady profitable growth. In other words, the variability of their profitability is less. So put these three things together and you get the quality as a parameter, which essentially leaves us with a very simple outcome that these businesses are profit making with low risk of bankruptcy because they have low debt, and at the same time they are able to generate profits which are steady. It's not like one year they'll generate massive profits and the other year they'll basically not generate profits. That helps this basically the businesses to sustain over longer periods of time, and that is why they are known as quality in terms of the factor selection. Thank you.
All right. Okay. So while quality ETFs follow a rule-based approach to selecting stocks, like you mentioned, debt to equity and return on equity, as well as steady growth, based on your experience, do you think that there could be a sectoral bias in these ETFs, or is it mostly in the large caps?
So effectively, quality as a factor. So large cap, mid cap, or small cap depends on the selection of the universe. Generally, the 200 stock universe and 30 stock selection. That's generally how the quality. I mean, that's the more popular one in terms of quality in India today. So top 200 names, and you select the 30 stocks out of the top 200 names. That essentially is obviously there'll be a bias towards large cap because top 200 names would include 100 stocks in the large cap and 100 stocks in the mid cap. So there will be a bias, but the top 200 names, you select 30 stocks. That's essentially where the quality as a factor would probably play in. As far as sector is concerned, naturally there will be certain stocks which have a higher debt to equity levels. They will be ruled out. There will be certain sectors which have a higher variability of their profitability. For example, cyclical sectors like auto, banking, metals, they will have a higher cyclicality of their earnings. So they will probably get ranked lower. At the same time, sectors like information technology, which is the technology companies, or FMCG, which is the fast moving consumer goods, they will have a much more steadier business with low requirement of debt and a higher return on equity because they are not very capital intensive. So by definition, quality as a portfolio, while there are 8 to 10 sectors in the current setup also, there will be a tilt towards those sectors which require less capital to grow, which have more stability of earnings, and which have profitability which is higher in terms of return on equity. And that is where the tilt generally is towards, in at least in the case of India, towards segments like FMCG or technology, which have more predictability of earnings and less requirement of capital. But there are about 8 to 10 sectors in the index right now, but the tilt is going to be towards the higher quality sectors which require lower capital. And that is generally the case with almost all the factor based segments or factor based ETFs, where you'll find certain sector tilt depending on the factor. For example, value as a factor will tilt towards higher dividend paying, lower valuation, price to earnings, price to book. So sectors such as say banking or oil and gas, you'll find a larger element over there in terms of the value. While in the case of quality, you're finding FMCG technology as being slightly higher weight in terms of their construct. Thank you.
All right, so steadier business is the core for choosing stocks for quality. But many investors worry about market downturns. So, do quality ETFs tend to perform better during market volatility or when the market is in a downtrend? And please also tell me, how do they compare with actively managed quality funds?
So, as far as market downturns are concerned, generally the segments which tend to take a significant fall in market downturns are where the earnings, are very unpredictable, or the earnings take a very sharp hit, and that's generally the cyclical sector. So normally in a market upturn, cyclical sectors do better than quality, and in a market downturn, cyclical sectors will probably underperform quality. So yes, to an extent, when there is a market downturn or a sharp fall, because the quality as a factor, the stocks are generally slightly more stable in terms of their profitability, they will tend to probably do better. But in general, as investors, what investors should look at is that over a period of 10 years, 15 years, that is when the entire cycle of equity is there, are you able to capture the essence of a particular equity rally which happens in a sensible manner? And that's where, whether it is any factor that you choose, the importance is that are you able to invest at the right time, and more importantly, not take out money when the markets are weak. So, for example, 2015 to 2020 was a big quality rally. While broader markets were sideways, quality stocks did excellent. So that would have led to a significant outperformance of quality over, let's say, value or other factors. And then 2021, post COVID, when the market rallied meaningfully till 2024 September. In those 4 years, cyclicals did very well. Capital goods, metals, banking, etc., did very well. So you would find that these cyclical sectors did better than quality. So 2015 to 20, quality did better. 2021 to 24, say value would have done better. But for an investor, essentially, who does not want to time the market, running through this entire process of being invested and more importantly, avoiding investing when the particular segment has already done well. So the best is, of course, SIP, and you can do SIPs even in the or SEPs, or you can continue to accumulate ETFs over longer periods of time, no matter which factor you take. Two things which are important is don't get into a factor when the factor has done very well, and don't get out of the factor when the factor has done badly, even if you are invested in it. And if you follow these two rules, then it does not matter which factor is doing badly or well, as long as you are consistent in your investing. But yes, to answer your questions in a simple manner, when the markets fall, generally the cyclicals take a bigger hit and the quality does. better generally. Thank you.
Thank you for explaining so beautifully. Avoiding investing when the factor has already done well. So I'll come back to the timing of investment, but before that, I want to ask what kind of investors can benefit from quality ETFs? Who are these more suitable for?
So, as the name suggests, we are investing in high quality businesses through the quality ETF. And if you look at the high quality businesses, generally, and since the rebalancing happens every 6 months, and the selection of the stocks happens on the basis of these three parameters, and every 6 months, the shortlisting happens, and if there are certain stocks which may go out, there are certain stocks which may come in. So there is an element of automatic, rebalancing which happens, and some stocks will go out, some stocks will get in, and at all points of time, investors will get the benefit of higher quality businesses being part of their portfolio. And for most investors who are not very active investors in terms of putting money, taking out money, etc., and are not very closely watching the markets on a day-to-day basis, it is best to invest in high quality businesses which over longer periods of time allow them to participate in the economy's growth. Because if you look at the economy's growth, quality businesses are always going to be beneficial in terms of their ability to generate higher returns compared to, let's say, the benchmarks, and also their profitability is likely to be better. So no matter whether it's a first time investor or an investor who's been a seasoned investor, as long as you are able to have the basics right in terms of equity allocation and ability to hold on for a longer period of time, quality as a factor is absolutely fit for you. Thank you.
Now, coming to the timing factor, timing matters in investing, as we have also discussed. So, how can investors learn the right entry point for investing in whether be it quality ETFs, value, low volatility, or other such factor based ETFs? How critical is the entry point?
So I think, as I was mentioning in one of the previous answers, timing matters to a very large extent when you're investing in factor based ETFs or when you're investing in any kind of equity investing, to the extent that you should not be investing when a particular factor or a segment has already done too well, and because there is a risk of you basically getting a higher price for that particular factor in terms of it already having done well, and then there will be accumulation or a consolidation phase which you'll have to basically hold on patiently, and then again it will go up, but it basically reduces your future returns. The whole point is that we are all trying to basically improve our returns or yields on our investments, and for that, in terms of timing, avoiding a sector or a segment or a factor which has already done too well is one of the ways or one of the checklists that we should have. Apart from that, if you're investing systematically over a longer periods of time, then the averaging the price averaging takes place, rupee cost averaging takes place, and you don't need to really worry about the timing aspect. But if you're investing in lump sum, just be sure that you should not be getting in when the segment has already done too well. And if the segment has done too badly, then yes, then it is a easier decision to invest. But the only thing is, once a factor is done badly, it may continue to do badly for a period of time, and that is the time when you hold on patiently. And then when there is an uptick, then you have to still hold on patiently when that full uptick is basically taking place, because you don't want to really get out when your investment is just about starting to perform. So the whole idea is be patient, and in terms of long term, if you keep accumulating units and have a steady investment portfolio, you really will not have to worry about your investments. But all of this sounds probably a little bit more complicated, but if you break it down and make it simple into selecting based on your risk profile, and of course, your advisors can help you on that. Your portfolio can be handled by professionals. They will tell you, okay, this is suitable for you in terms of your risk profile, and then basically create a asset allocation wherein, be it quality, be it value, be it alpha low or momentum, whatever the segments are in terms of strategy indices, they will fit in well. And at the end of it, the whole objective is that over 10 years, 15 years, 20 years time, you've generated a good corpus and good returns for yourself, to take the advantage of the investments that you're making today. Thank you.
All right. In our previous sessions, we have discussed a multi-factor approach. So, wouldn't that be a better strategy for equity exposure than investing in just a single factor, say as quality ETF?
So when we discussed multi-factor predominantly, we had discussed alpha low vol, which is essentially a price-based product wherein we are talking of those stocks which have done well at the same time have a lower volatility. So not the stocks which have done the best at all in the last 6 months, 12 months, but the stocks which have done best with lower volatility. So two factors coming together. So multi-factor also has its own charm, but that's on the price-based factors. As far as fundamental factors are concerned, also, as long as the two, three factors which are being basically taken together do not cancel out the benefits of each other, it's no harm. And so, but the very fact is that quality is a very large segment and it's a very separate segment. So, quality has its own place in an investor's portfolio. One can argue that value has its own space in an investor's portfolio because when value performs, it performs very well, as we've seen between 2021 to 2024. At the same time, when value didn't perform between 2016, 17, and 2021, many investors lost patience. So, if you mix value and quality, you'll end up basically getting the broad market returns, which probably is not the objective of an investor's investing. So, multi-factor investing, as long as the factors or the multiple factors which are part of the index are not cutting out the benefits of each other, that should be fine. But generally, and so alpha low vol, which is price based, multi-factor of two factors, that's fine because it's essentially giving you speed with stability as a price factor. But as far as fundamental factors are concerned, a mixture of those is fine as long as they are not kind of diluting the impact of each other. So quality and value won't probably go hand in hand. But yes, quality separately and value separately has its own benefits in the investor's portfolio if you can get it right in terms of when you enter the factors in your portfolio. Thank you.
All right. Okay. As no investment is risk-free, could you explain the risks associated with investing in quality ETFs and how they compare with the quality mutual funds?
So, number one, ultimately the investment is happening in equities and it is subject to equity market risks, which could be multiple, right? It could be because of global factors, local factors, and that you avoid by basically diversifying the portfolio. So the good news is that when you have a 30 stock portfolio, at least the diversification risk is not a problem. But yes, the global risk or the equity market risk per se, like we've seen in the last 1.5 month, right? That most of the things have fallen, whether they are good, bad, or ugly. Most of the things have fallen. Of course, quality as a factor may have fallen less. But clearly, when there is a sharp sell off, the equity market risk is basically something which investors have to keep in mind. Apart from that, of course, the risk of temporary loss or a temporary drawdown which can happen, and if investors aren't able to take that temporary loss, so that can be avoided if you have investments which are for long term. So we always say that you should invest minimum with a 5 year horizon in equity markets to be able to get the full benefit, and even longer for that matter. And hence, the key risk, of course, is equity market risk, and the other risk is if a single factor does badly for a longer period of time. So, for example, if let's say value or quality or low vol does badly for a long period of time, then that can be a risk for an investor's portfolio because some other factors will do well. So, there a combination of factors can definitely help in terms of you selecting three, four funds, and that is why we always say that no single fund should be more than 15 to 20% of your portfolio, so that you get the advantage of diversification. At the same time, you should not have 30, 40 funds because that diversification will ultimately also not be fruitful in your portfolio. So the risk is only of equity market risk and timing and patience. So if you have longer term money and if you're able to handle volatility, then the risk should not matter too much. But yes, equities carry the risk of sharp sell offs and longer periods of non performance. That's something which the investor should keep in mind. Thank you.
Okay, so sharp sell-off and longer periods of investments. So these are the key two risks involved in quality ETFs. But one who can invest for long term can definitely think about it. Now we have talked about risk profiles, market cycles, and potential risks. Are there any other key factors that investors should consider before investing in quality ETFs? Just reiterating my question, is there any other risk involved?
No, so I think within the factor, there is no risk. I've already mentioned about the risk. So I think the return is what we all want, but the risks of equity remain. And specifically in quality or in factor-based ETFs, we should remember that factors ultimately also have their own cycles. So, understanding the risks of the factors and staying patiently invested in those factors are the only two suggestions which I will give investors as far as risk to factor-based ETFs are concerned. Thank you.
Thank you. And finally, the big question on every investor's mind, is this the right time to transition from a broad-based index ETFs or a growth ETF to quality ETF?
Yes, so ideally, if you have a very high exposure to, let's say, any segment in the last 3 4 years, because mid cap small caps have done too well, momentum as a strategy has done too well, if you have extreme exposures, very high levels of exposures to these segments, maybe then you want to switch from there to higher quality, because quality in the last 3 4 years has not performed, and quality will provide a little bit more stability to the overall portfolio also. So it all depends on your portfolio construct right now. If you're not having too much high exposure to momentum, mid caps, small caps, or the segments which have done very well, then you really don't need to worry about shifting anything. I'm not a firm believer that you should shift. The longer you allow your investments to grow, it's better. But yes, if you have investments like mid caps, small caps, momentum, where you have very high levels of exposure, let's say 40, 50% in these
Mhm.
three, then you can look to shift some of the profit booking that you do from these segments like mid cap, small cap, momentum, etc., to quality. But that's only if you have a very high exposure. If your exposure levels are not very high in these segments, then you really don't need to look at shifting away towards quality. But incremental money, definitely, given that quality has underperformed, or quality has probably for the last 3 4 years has been steady at best, the valuations which were very expensive for quality names have become much more rational or reasonable. And so I would suggest investors to look at quality as a factor for their incremental investing, if not for switching. Thank you.
Okay. The quality ETF invest in stocks based on certain criteria and rules such as profitability, low leverage, stable earnings. Quality factor typically perform better during market downturns. However, it is always better to take personalized advice from a certified advisor before investing to build a resilient portfolio. Thank you, Mr. Haria, for detailed answers to our questions. Your insights will surely help our listeners make better financial decisions. It's
Thank you
important to
so
note
much.
that the contents of the discussion should not be construed as an editorial recommendation from Outlook Money. And with that, we come to the end of today's episode of the Investment Made Easy podcast. Stay tuned for our next edition in the Outlook Money's podcast series. And don't forget to like, share, and subscribe. If you have any suggestions, feedback, or questions, please send them to us at letters@outlookmoney.com. Until our next edition, take care and stay well.